Good evening, everyone. Dan Bird here with the Daily Scan for February 25th, Tuesday. And as I said last week with Max Payne usually extends into Monday or Tuesday of the following week. And that's exactly what happened this week. It looks like to me, though, that the selling might be abating. Probably did a little bit towards the end of the day. So we'll take a look at it here in a minute. But today I'm going to do a technical Tuesday. I'm going to talk about moving averages and explain what they are, how they're put together, and show you the ones that I use. And whether you can use those or not, or choose your own, that's up to you. So we'll take a look at those and hopefully educate people on what moving averages can do. As always, I am not a financial advisor, so anything I say is for educational purposes only, and I am not going to make recommendations of what to buy or sell, or when to buy or sell them. Let's take a look at the homepage on the website, breakpointtrading.net. This is where you can find the newsletter in this little box right here. It's free. You don't need a subscription to do that. The YouTube channel button is on here as well. You also can check earnings. So there's a little button here that allows you to filter for earnings coming up the next week or so. I still have a red light, and the market bias went down actually even steeper today than it did yesterday. So it's continuing to fall 3 days in a row. Usually, and I'll show you this on a chart in a minute, but usually 3 days with big red candles is typically about as much as the market usually will fall. Doesn't mean it won't fall more, but usually you'll get a relief rally after about 3 days of long red candles. And I think we might have started that towards the end of the day today, but we'll see. Let's take a look at the S&P real quick first, and I'll show you what I mean with those candles. So you see right there, there's 3 red ones. You can see this one was a nice big solid candle earlier today, and then it came back, and that now is a hammer. So a hammer is a bullish reversal candle. I covered candle patterns in a previous Technical Tuesday, so for those that might have missed it, if you're interested in understanding what candles, how to read candles, you can go back and watch that one from a few weeks ago. So we did get a hammer today after 3 solid red candles. So I think that means we're probably going to get a bounce. We'll get a relief rally, probably back up to the 21-day reversion to the mean, which is up around 640, something like that. We ended today 59.55. So the key level is 58.50. Down here, we're not there yet, but we need to watch that. But let's see what happens tomorrow. I think we might get a relief rally, depending on what happens with NVIDIA. So NVIDIA reports after the close tomorrow. And I'll talk about that on the Daily Scan tomorrow as well, because we'll look at what actually happened. But that could be what propels the market higher if NVIDIA has a positive report. If not, then this rally that probably will start tomorrow might be short-lived. We shall see. Okay, NASDAQ 100 should look the same. Another hammer, kind of a hammer, like for this actually to have closed higher up. So it's almost a hammer, not quite really, but still 3 red down. That usually means we're going to get a bounce, relief rally tomorrow. Bitcoin had a big sell-off today. We'll see how it bounced back. And it came back too, also has a candle that went right down to the lower 3x ATR, average true range down here. Made it all the way down here to 86,000. So pretty low for Bitcoin. Bitcoin momentum has been below 0, so it's confirmed downtrend. And it is accelerating to the downside, even though looked like it might start to come back above 0, but that didn't happen. It started to accelerate down again. So we'll see. Again, NVIDIA is probably going to carry this as it will everything else tomorrow. So we might get a relief rally in Bitcoin, might bounce back up, and then we'll wait and see what happens. Let's go take a look at on the market bias matrix. Lots of red on here. That's what pushed it down. You can see right there. We now have 4 reds straight across 2 days in a row. So you can kind of look at the color guard here and just get a sense for what the colors look like as it changes from red to yellow to green, and then now it's going back to red again. But let's take a look at the 10-year yield. That dropped again. I said it was probably going to 4.25, and the low today was 4.28. So 4.25 is what I said based on this head and shoulders pattern right here. The target would be right down here. And in fact, I can extend that over. Target would be right about there. So just about there, and it looks like it might go down some more tomorrow. So head and shoulders pattern looked like it was a good signal right through here. Kind of negated itself when it had this big rally right through here, but then it came back and continued down through the support line. So that usually is good for the market, but in this case, I think it could be signaling a potential slowdown in the economy. So it's sort of, in this case, the reverse of what you would think it should be. Bitcoin, again, a different look of Bitcoin. There's those red candles right there. 82,000 is where the 200-day is. There's a potential it could get down that low. So we'll have to see. Big volume today, too, on the selling. If we look at this on a 30-minute chart, you can see all that volume was mostly selling. It did bounce back a little bit at the end of the day, but most of the day it was mostly all selling. So Bitcoin looks like it might continue after a relief rally, just like the rest of the market. So keep an eye on that. Interestingly, let's take a look at MicroStrategy, just out of curiosity. Looks very similar to Bitcoin. So MicroStrategy is falling too. Michael Saylor's buy point is around, I think it's around 64,000 for Bitcoin. So if Bitcoin continues to fall, then he could be in trouble. They might start calling his loans in. Of course, it's pretty far down. So it's way down here. 64,000 is way down here. It really needs to go down pretty far before he really will need to worry much. But it definitely is affecting his stock price on his company, MicroStrategy. And as I've shown before, Bitcoin is highly correlated. We go to the charts page. There's a Bitcoin section over here. Right here, correlation to the triple Q. And you can see right here. So when this is the correlation between two things, correlation in this case between Bitcoin and the leveraged NASDAQ 100. So you can see Bitcoin began to fall today, but ever since way back here in 2022, pretty much where the bottom were in the end of 22, where everything bottomed and started moving higher. That's where Bitcoin and the NASDAQ 100 became highly correlated. It varied a little bit in through this period, but for most of this year, most of last year, I should say, and all the way into this year, it is actually becoming more and more correlated. So what that means is if the NASDAQ 100 and the rest of the market falls apart and drops significantly, then Bitcoin will drop as well. It is highly correlated now, not like it was back here in 2016, 2015, when people were first starting to notice it. It was inversely correlated back then, but it is now highly correlated. So if the NASDAQ falls, so will Bitcoin. So watch out. All right, let me take a look at a couple of stocks that people asked about before I get into the moving averages. So one person had an interesting comment about Coca-Cola and a company that I had not heard of, and saying that maybe these are bucking the trend. And I noticed Coca-Cola too has really just been zooming higher. So it's way up here. It's getting close to, in fact, it's probably right at a support level right now. So support is probably right in this area. So it's just about there, 72. It will likely hit resistance and pull back right in this area. But yes, Coca-Cola, which is part of consumer staples, we'll look at the sectors in a minute. Consumer staples has been one that's outperforming. It is a defensive sector, and Coca-Cola is one of the main stocks in that sector. So yes, absolutely, Coca-Cola is bucking the trend of the rest of the market. It probably will stall a little bit right here. So watch out for that, but it might be an opportunity to get in. The other one was QSR, which I don't know anything about this company. It's called Restaurant Brands International. This one doesn't look nearly as good. And in fact, it is trending down. It's below its 200-day moving average. It's sitting right at all of the other moving averages. We'll talk about these, what all this means in a minute. But it does not look nearly as good as Coca-Cola. So I would not put this in the same camp as Coca-Cola. Looks like it's in the restaurant business, but this one definitely looks like it's kind of sad. It's heading lower. It could bounce back up to the 200, but I expect it will get rejected there and go back down. So Coke is a win and Restaurant Brands is not. All right, the last one here is someone made a comment about SPY, which is the S&P. And you can see there's the hammer, so it looks like the rest of them. 3 solid down days below the 50-day moving average. But the comment that was made was SPY could likely fall and go down 20% by June. By June. So June is March, April, May, June, 4 months away. Can this go down 20% by June? Now, I don't know what that 20% means exactly because they didn't specify. But if we assume it's 20% from the high being 613, 20% from there would be 490. So that would be way down here. So let me draw some lines in here. Let's draw it. Let's make this red and put it down here at 490. Right down, way down here. 490, right there. Okay, there's 490. So that would put it basically back here at the low of April of 24. So essentially giving back everything that we made for the whole year. So could that happen? Yes, certainly it could happen. There will be a lot of things that will have to happen for that to go down that far, though. It's got a lot of resistance levels to get through, certainly. Now, if he's talking about, this was yesterday, so if we say 20% from the close of yesterday, which was 597, 20% from there is 478, which is not even on this chart. So if I go, let me go another 6 months. So now we'll put another line here at 478 and see what that gives us. I'll keep it red. 478 is right about down here, right there. It's actually 477.60. It's the exact number. So that's about right there. So somewhere in that range, basically, is what this person is suggesting that the S&P will get to by June of this year. That's pretty aggressive. That means probably everything is falling apart in the whole market. It will not be good. So let's do this. Somewhere in this range right there. So the world will be ending from a stock perspective if that happens. Could it happen? Absolutely, it could happen. Yes, we've had crashes like that before. 20% is certainly within the realm of possibility. Within 4 months, yeah, it could happen in 4 months as well. Let's do one more thing. Let's put some Fibonacci levels in here and get a sense for what that might look like for Fibonacci retracements using the low down here and take it up to the high up here. All right, let's make this one solid. So Fibonacci's, we'd have to get through 563 right here, major support. We'd have to get through 532. It's at the 38% level. We'd have to get through this low right here. So that is another major support level, 50% down at 508. And then notice that the 61.8, 62% Fibonacci is right smack in the middle of this range right down here. So yes, that absolutely is an area where it could go to. So not out of the realm of possibility. So is that something that's scary to people? Well, if you're listening to this channel, it should not be scary, because just as I showed last week, I've already given warnings. I've given plenty of warnings to everybody. So everyone should be well prepared. If we fall through 58.50, which on this would be 585, right about here. So if we fall through this level, let me put one in here. This is the near-term major support right here. Right about there, a little bit higher than that, 585. Right about there. And you can see where it's clearly major support. It's the top of this gap right here. It's the top of this run up when it pulled back, broke through it, and then kept coming back down, touched it 1, 2, 3, went a little below 4 times. So that's major support. So that's the area in the short term, probably within the next month, let's say. Maybe it could be sooner than that, actually. Let's say the next 2 weeks. We could go down and test that. Now, what the market usually does when it tests support levels like that is it does not go straight down. So I want to make that clear. We could go down and test this, and most likely it will bounce back up, probably back to the 50-day. And then it will start down again, and it will get down here to around the 200-day, and it will bounce there and go back up. So this will not happen in a straight line unless we have a major issue like another COVID, for instance. COVID sent it down that much in just really just a 2-week period. But barring a black swan event like that, this could certainly get down here, but I do not think it would happen by June. I would think it more reasonable if someone were to say 20% by October. I think that is certainly doable. And usually October is where bear markets end. But, and we certainly could get that low, but I don't think we'll get there by June. So that's just my opinion. So I'm just showing you the chart, see what it looks like. So there you go. All right, let's talk about moving averages. So I'm going to go to Stock Charts has a chart school. You can look up pretty much anything you want to learn about technical analysis you can find on Chart School. So we're going to look at both simple and exponential moving averages. What is a moving average? It basically takes a period of time and takes the data points from, usually it's the close for that period. Let's say, for example, 10 days, and it averages those prices over that 10-day period, averages the close over a 10-day period. And then on day 11, it drops day 1 off, adds day 11, and then averages them out again, and then creates a line that smooths all of those averages out over time. So best way to use moving averages, they are used as the building blocks for Bollinger Bands, MACD, McClellan Oscillator, and many other indicators as well. MACD stands for Moving Average Convergence Divergence. So the MACD indicator basically just, you identify 2 moving averages, and it will show you where they converge, where they come together like this, and where they diverge, where they move apart from each other. Now, what this is showing you here is the difference between an exponential moving average and a simple moving average. So this is a matter, in fact, moving averages themselves are really a matter of personal preference. And you'll see different people using different time frames, different types of moving averages. I have ones that I like. The most important thing is to pick something and stick with it. You have to understand the personality of the indicators, and that takes a long time to do. So you have to use a standard set of indicators and don't keep changing them out. So what you're seeing here is what the exponential would look like. This is a 10-day. versus a simple moving average. What an exponential moving average does, well, first of all, understand that by definition, moving averages are lagging indicators. So if you're looking at 10 days, then it'll take you 10 days to get enough data to create an average. So it's a 10-day lag in that case. So they will always move slower than the actual price. Actual price is the most important thing. So it's important to understand that. So now you can see a 10-day, 100-day is the red line, and a 50-day is the black line. By the way, traders on Wall Street typically use the 50-day line, as a place to either take an entry or add to their position. I've said many times that big companies on Wall Street cannot add or take positions quickly. They can't do it in one day. They can't do it in 1 week usually. Sometimes it takes them months to do it. And what they do, if they do it over months, is they wait for a pullback to the 50-day or the 200-day. And then they buy more. So that's why those lines are so important. So how do you calculate? Simple moving averages, just like I said, you just take a time frame, you add them up, you take the average. Exponential moving average, on the other hand, puts more weight on the last few days. So if it's a 10-day moving average, then it's going to put more weight on the last 2 or 3 days of the average. So it will move a little bit faster, and it'll be more sensitive to the price. So the exponential moving average really can help a lot on the shorter time frames, the lower time frames. It shows you a spreadsheet. There was a line in here that I thought was really good that said the exponential moving average, when it gets out to a certain point, the amount that it's adding to the accuracy is really minimized. So for me, when you get to 50 days, it really does not make much sense to use exponential unless you're using exponential for everything. So what I like to do is use exponential for anything less than 50, and I use simple moving average for anything that is 50 or above. So that's the way I like to do it, but you can do it any way you want. I asked John Carter this question, and he says he uses exponential for everything. So that's just the way he likes to look at charts. He's used to it. He's looked at them for so long. He understands the personality. So it's really up to you how you want to do it. Down here, you have a 50-day simple, the red one, and a 50-day exponential, the green one. And you can see right here that the green one moves more quickly than the red one, especially during turns, especially when the price starts to oscillate more. If there's a solid trend of a pretty steady trend, then the both of them will pretty much trend together. But once it starts to move in an opposite direction, that's when you start to see the convergence and divergence of these simple versus exponential. So another way to do it is, you can use a single moving average and just say if it's above this is what many traders do using the 200-day. If it's above the 200, that means that overall the long-term trend is up. If it's below the 200-day, then the long-term trend is down. In this case, this is the 150-day, and so yeah, and I like to use the 200-day for that. Then you can use two moving averages together. So you can use the 5-day, a 10-day, and a 20, all moving together. And when they cross, when the faster one crosses the slower one, that indicates a change of character. Now, once again, if you're just looking at the fastest one, a 10-day and a 50, or in my case, you can get whipsawed. In my case, I use a 5 and a 21. So there's a potential to get whipsawed because it moves so quickly. The short-term ones can move very quickly. The longer-term ones don't. So this 50-day and 200-day, this would be my long-term signal right there. My medium-term signal is when the 21 crosses the 50-day, and my short-term is the 5 and the 21, which can cause whipsaws. So you have to be aware of that and use other indicators as well, like the MACD, for instance, just to confirm it. So that's kind of how moving averages are put together. You can use them for support and resistance many times, especially with the 50-day. Now here's a 200-day. So this is a good example. The New York Stock Exchange. This is a 200 day. This is again where big institutions like to add when it pulls back to the 200. So you can definitely see that this is in a long-term uptrend right now. And then we get the distribution phase that I've been talking about the last month or two, where things start to oscillate and go back and forth. And no longer is it acting as support like it was before. And then it drops through the 200 and then comes back and touches it again. So tests it and then gets rejected. And that's usually what happens just before an extended downtrend. I think that I talked about that a few minutes ago when I talked about the 3 red bars, that probably it will bounce and get a reaction rally and come back up. And then at some point, it won't make it back to the previous highs. It will get rejected at a 21 or a 50, and then it will head down into an extended downtrend. And that's where, that's how you'll get out before that 20% crash. And I'll give people plenty of warning too. I've already been giving warnings, so hopefully everybody knows that. So this is how it looks in stock charts. So let's go take a look at stock charts and look at a couple of these. Here's the S&P. This is my default view. So for me, I like the 5 exponential and which is pink, 21 exponential, which is blue, and the red one is the 50-day simple moving average. And then I put the 200-day in gray down below. And usually those are the 4 that I like to use. There's a few ways you can do this. You can say wait till it crosses, and then there's a character change. You can see it happen right here, and then it cross back above again right there. Or you can wait for it to just cross the 21, and usually the 5 will follow shortly after that, so you get a little bit of advanced warning. Or if you're more of a medium-term to long-term trader, then wait for the 21 to cross the 50. But again, you can get some whipsaws if that happens. So use your other indicators, like when the MACD goes below 0, then it's confirming a downtrend. So that can confirm this right here. So those are the 4 moving averages that I like to use. If we look at this, let's see. Let's look at it here. You can create a scan for this as well. So I created a scan called the 5 crossing the 21. But the way I design the scan is I'm looking for the price to close above the 21. So price is above the 21, but the 5 moving average has not yet crossed. So in other words, it is not yet crossed, but it probably will in one more day. So by doing it this way, by looking for the price to cross above the 21, but the 5-day to still be below it, gives you about a 1-day lead time before the actual cross of those moving averages. So you can see here with air products and chemicals, that's where the cross happened. This can be a good technique for those that are doing options. If you like to sell puts, for instance, on the bullish side, then just wait for something like this to happen, or scan for it. Use a scan to scan for it, or look at the stocks that you typically like to look at, which we'll look at the Magnificent 7 with the moving averages here in a minute. But as soon as this happens, you can sell a put, but you can sell it right down here at the bottom of this first candle. So in this case, it would be around 310. And it's pretty likely, especially if the market is cooperating, it's pretty likely that it's not going to come back to 310. It's going to continue going up, especially as the 5 crosses the 10 and the price keeps working its way back up to resistance up here at 338. So that's a way for a short-term trader looking at options can play something like this, can play the moving averages to identify something like that. So let's go take a look at the Magnificent 7 real quick. And you can now take a look and see what the moving averages look like. So right here, 5 crossed the 21, it had already gapped down. However, right here is, I don't want to do it that way. Let me do it this way. All right, so that's where it crossed right there, but it actually gapped down the day before. So you might have had some advanced warning because momentum is falling. It went below 0 way back here. So even as the price is moving higher, momentum is moving lower. That is a negative divergence. So it's giving you advance warning that the uptrend is running out of steam and getting ready to reverse. So you could have anticipated this. And if not, you just get out right here. As soon as this went below the 21 day, and the next day the 5 crossed. So that's Google. Here's Amazon. Amazon has 2 crosses now. So there's the 5 crossing the 21 right there. So you could have got out at 230. Then the 21 crossed the 50 right here. So you could have got out at about 213. And today it's continuing to go lower. Again, as and I love looking for divergences. They can be very powerful. You've got an uptrend right here on price, and you have a downtrend on momentum. So that is a bearish divergence. It's giving you advance warning that this is getting ready. It's running out of steam. Even though it's hitting new highs, the momentum is declining. So it's getting ready to roll over, most likely. So you could have paid attention to this and got out right here on this first red bar, which is where I would usually get out, right on the first red bar when it crosses below the 21. Now the 5 crossed 3 days later. That's what I meant by watching the close below the 21 with the 5 still above it, and that can give you advanced notice. So there's Amazon, there's Apple. Apple had an uptrend right over here. So here the 5 crossed above. And by the way, all of this can be seen on my trend models. So this is the trend model for the Magnificent Seven. You can see as soon as the 5 crosses the 21, these turn red and it gets highlighted. So this one happened today. Meta just happened today. Netflix happened yesterday. So if we look at Meta, you can see it just had a bearish crossover right there. And it crossed the 21 right there. So this is where I would sell a call or a call spread right here on this day. I would sell the call up here at 735. And because momentum and everything else is showing it's probably going to go down, and then the 5 crossed right there. So if you did this for just a 2-week period, for instance, or even a 1-week period, you can make 50% on your money just in about 7 or 8 days. So that's the way I like to use the moving averages. I like to watch for the crossover below the 21, which is right on this red arrow. And I put these right on these charts. So right on the trend models, for those that are subscribers, I put it right on there. Here's NVIDIA. NVIDIA had a crossover today. So they're reporting tomorrow. So there's NVIDIA. They had crossover right there below the 21, and then the 5 crossed today. And it's sitting right on its 200-day moving average. Very, very, very critical for NVIDIA. They, again, like I said yesterday, they have to have a perfect earnings report tomorrow. Momentum is rolling over, sitting right on the 0 line. So everything about this is saying if they have any hiccup whatsoever in that earnings, this thing is probably going to gap down quite a bit. Now, NVIDIA could have great earnings. So Netflix, another one, happened today. So it went below the 21 right there. So this one is just giving the signal. So again, if you just use the Magnificent Seven for selling calls and selling puts, you could have sold a call up here at 1,050 right here. It's likely going to continue lower, probably won't go back up and take that out. So just hold that for a week or two and let it expire worthless, or I like to get out at 50 or 70% gain on these kind of things. But this is a great way to use the trend models for doing options. So that's moving averages. You will see different types of moving averages. Different people will use different ones. Again, it's personal preference. The most important thing is pick something and stick with it so that you can really understand its personality and what typically happens. You can see the right back here is where we got a whipsaw briefly, but you never know. It could just continue going down. But there was a whipsaw right here. So this would actually, you would have been out and then back in again in just 4 days. But this one here had this whole downtrend you could have missed, and you get back in at a lower price right when it goes back above the 21. So anyway, that's the way to use moving averages. That's what I like to do. Also, I like using Fibonacci numbers. So mine are 5, 21, 50 is not a Fibonacci, but it's the one that every other trader out there uses. And 200 is also not a Fibonacci. The Fibonacci closest to 50, by the way, is 55. The Fibonacci closest to 200 is 144. And then it goes to 250 something. So 250 is probably 251, I think it is. But anyway, 200 is what everybody else uses. So that's why I have that one on there. But you can use anything you want. And another way you can do it, and one of the things that John Carter teaches, is he likes to see stacked moving averages. So what that means is the faster ones are above the slower ones. If the faster ones, the 5, the 21, and the 50, are above the 200, then it is absolutely in an uptrend. So that's what he likes to see, stacked moving averages. And I actually have a button here that shows the stacked moving averages right here. That's what it looks like. So those are stacked moving averages for Netflix. You can see the fast one, the 5-day. I actually highlighted the 5, 21, 50, and then the 200 is the dashed gray line at the bottom. But you can see all the different moving averages in here, all stacked above each other. The fastest one dipped down briefly, but then the rest of them didn't. The rest of them never went below the other ones. And it's starting to dip down again right here. So we'll see what happens. If you want to see what unstacked looks like, if you want to see what the opposite of this looks like, look at AMD. There's moving averages stacked, the bearish moving average. So now the faster ones are on the bottom and the 200 is on the top, the slower ones on the top. This is absolutely what you don't want to see if you're trying to be long on something. If you want to be short, then it's certainly what you want to see. But if you're trying to be long on something, you do not want to see moving averages like that. By the way, on the website for subscribers, on the chart lists and scans page, I have all of my buttons, my favorite styles over here. You can see the moving average squeeze. This is the stack moving averages. I use Netflix as the example for these. I update these occasionally, so I might be doing that again pretty soon because I like to change some of these. Some of them stay the same. So most of these down at the bottom always stay the same. But if you just click on that moving average, it'll show you Netflix, and that's the stack moving averages that I just showed. And then you can add it to your own stock charts and add a button over here on the left. So you can have one of these as well that looks just like mine. So I just make things for those that are stock charts subscribers. I try to make things pretty easy, as easy as I can, including some of the scans that I run. So those are right in here too. You can just click on one of these. You can copy and paste the scan into stock charts and create your own scan. But you do need to have a stock charts subscription to do that. All right, so that's pretty much it for today. I will quickly show the dashboard today. There's Bitcoin, so 88,000. It was down much lower than that earlier. Equities, the Dow actually ended higher. The VIX, though, is at 1943. So even with those hammers that we had at the end of the day, the VIX, and I want to look at that because that could give us a clue to the rest of the week. Let's look at the VIX over here, right here. So you can see now it actually went into the above 20, which is bearish territory, but it pulled back below 20, sitting right at 1943. So definitely moving higher. The rate of change is going higher. The moving average lines are crossing right here. So that's indicating that it's a character change starting to move higher. If the VIX goes up here later this week and stays above 20, then we will be in for an extended downtrend. And then we might go down to that 20% level. But again, I don't think it's going to be by June, but it could certainly be by October through the summertime. All right, so that's the VIX. And then if we look at the sectors, these are the sectors for today. You can see all defensive. Here's the S&P. So the ones outperforming are all defensive sectors up here. And the aggressive sectors are all at the bottom. NASDAQ 100, technology, communication services, discretionary, all down here below the S&P, underperforming. And if we can look at this on a candle glance, like I showed you yesterday, this puts them all together and it ranks them based on relative strength, and puts the best one in the upper left and the worst one in the lower right. So staples is the one that's outperforming everything else, and discretionary is the one that is underperforming everything else, which happens to be where Tesla is. So there's discretionary, another hammer. Pretty much all of these will probably have hammers. I can look at the rest of them. There's the NASDAQ, there's the S&P, there's the hammer. There's sort of a hammer on the Russell. This one doesn't. Materials actually started going higher. That's gold. That's not really a hammer on communications. It's more bearish. That's more bearish. Financials certainly does have a hammer. So, and industrials actually looks like it's making a recovery. Just out of curiosity, we can look at Tesla. You can see with Tesla, again, the MACD crossed here, right there. So first warning sign, then it started moving down, tried to come up and could not make another high. So now we have two lower highs. So there's the second warning sign. Then the 5-day crossed right there. There's the third warning sign. Then the MACD went below 0. There's the fourth warning sign. And then the 21 went below the 50. There's 5 warning signs. At that point, it was at about 377. And right now it's at 302. So your last warning could have got you out around 380 and would have saved you that $80 decline right there. And it looks like it's going to continue to decline. It will have a bounce, just like they always do. And it probably will bounce back up and hit the bottom of the 21-day again before continuing to go lower. But that's how you can tell when tops are in, when the market's rolling over, and you, by watching this channel, can avoid losing 20%. All right, please like and subscribe if you want me to continue doing these. Thanks everyone for watching. We'll see what happened with NVIDIA tomorrow night and see what the reaction with the market will be for the rest of the week. Thank you and have a nice evening. Take care.